Okay, so you want to own a health insurance company, not sell insurance, not work at one. Own one. You want to be the person who decides what gets paid and what doesn't, the person at the center of a $1.7 trillion industry that touches every American at their most vulnerable moment. Here's the paradox. Nobody tells you up front. The business model requires you to collect money for a promise you'd rather not keep. Health insurers make money by not paying for health care. But if you deny too much, the government regulates you into oblivion. And if you pay too much, your investors fire you. That tension between profit and obligation is the thing that either makes you a billionaire or sends you to the bottom of a very expensive sea. United Health Group pulled in $400 billion in revenue in 2024. So yeah, the ceiling is real, but so is the floor. Let's start with what it actually costs to get in. There are 3 levels, and they are not close to each other. At the bottom rung, you are building a small, regional HMO. Something like what Molina Healthcare looked like in its early days in California, serving a defined geographic area with a narrow network of contracted providers. To do this legally, you need state licensure from the insurance department, an actuarially certified rate filing, and a minimum capital surplus that varies by state, often $1.5 million to $5 million just to open the doors, plus your first year of operating expenses. Call it $5 million to $15 million to get a single state HMO off the ground if everything goes right. Most things will not. The middle tier is a state-licensed commercial insurer covering multiple lines: individual, small group, large group. Think of what Oscar Health looked like when it launched in New York in 2012 with $40 million in venture backing. A realistic mid-size multi-state commercial insurer needs $50 million to $150 million in capitalization before writing its first dollar of meaningful premium, because regulators require risk-based capital reserves proportional to the claims exposure you are taking on. And claims exposure, before you have any real claims history, is basically an educated guess, dressed up in actuarial language. At the top, you are talking about a national carrier, United Health, Cigna, Elevance, companies with tens of billions to hundreds of billions in annual revenue and actuarial infrastructure that took decades to build. Starting there from scratch is not a business plan. It is a fantasy. The realistic entry point for a national player is acquisition, and buying a mid-size regional insurer runs $500 million to several $billion. Centene bought WellCare in 2019 for $17.3 billion. Aetna paid $5.7 billion to absorb Coventry Healthcare in 2013. The point is, scale does not come cheap, and it does not come fast. And that's before the hidden entry costs hit you, which they will. Every state you want to operate in requires a separate certificate of authority from the state insurance department. That process takes 6 to 18 months and costs $50,000 to $250,000 in legal and filing fees per state. Beyond licensing, you need to fund statutory reserve accounts, money you cannot touch, calculated using the NAIC's risk-based capital formula. For a new insurer with $100 million in annual premium, that locked cushion might be $20 million to $30 million. On top of that, reinsurance. Before you can absorb large individual claims, you need stop-loss coverage from a reinsurer, which runs 5% to 15% of premiums in the early years when your risk pool is an unknown quantity. You also need actuaries, senior ones, who can accurately price a plan for a population they have never insured before. They cost $200,000 to $400,000 a year each. You will need several. Provider network contracting alone, negotiating rates with every hospital and physician group in your service area, takes 12 to 18 months and a full legal team. None of this shows up in the licensing fee. Okay, let's talk about how you actually make money, because the mechanism is counterintuitive in a way that trips up almost everyone who looks at this business from the outside. Think of it this way: you are not really in the healthcare business. You are in the cash flow management business. You are a bank that lends to sick people, except instead of interest, you collect premiums. Here is how the float works. A member pays you $600 a month. You collect that in January. Their knee replacement happens in March. You pay the hospital in May. That is 4 to 5 months when you are sitting on that money, earning investment income. Multiply that by 100,000 members, and you are holding $60 million in premiums every month before a single claim check goes out. The health insurance industry earned $13.9 billion in investment income in 2024. That is not from being good at healthcare. That is from having money earlier than you spend it. The bigger engine, the one the medical loss ratio, abbreviated MLR, actually governs, is the administrative margin. Under the Affordable Care Act, insurers in the individual and small group markets must spend at least 80 cents of every premium dollar on actual medical care. Large group plans face an 85% floor. If you fall short of those thresholds, you owe members a rebate check. Since 2012, insurers have paid back nearly $12 billion in rebates to consumers who overpaid. That number sounds like a consumer win. It is. But it also means the 15% to 20% administrative margin that remains is legally protected. Nobody can undercut you below that floor without breaking the law. The revenue formula is this: premiums minus claims equals your underwriting margin, and that margin must stay between 15% and 20% by law, plus whatever you earn on the float. On $720 million in annual premiums, 100,000 members paying $600 a month, and 85% MLR produces $108 million in administrative margin before $1 of investment income hits the books. Not bad, right? But that margin disappears fast when claims run hot. Here's the counterintuitive thing that breaks most people's brains when they first encounter it. The MLR requirement, which was supposed to squeeze insurer profits, actually made it harder to compete with the giants, not easier. Before the Affordable Care Act, a scrappy startup could undercut the big carriers on price by running lean, with minimal staff, low overhead, and bare-bones benefits. But when you set a legal floor on how much of every premium dollar must go to claims, you set a floor on how big you need to be to survive. A company with $10 million in premiums and $2 million in overhead runs exactly at the 20% administrative cost ceiling. Any unexpected cost, a bad flu season, one catastrophic case, a billing dispute, pushes them over the limit, and they are writing rebate checks instead of cashing profit checks. A company with $10 billion in premiums can spread that same $2 million of overhead across an ocean of revenue and never flinch. The Affordable Care Act's MLR rule did not squeeze United Health. It squeezed everyone trying to compete with United Health. Scale is the only protection, and the law made that true by design. There is a second structural advantage the dominant players have built that does not show up on a basic income statement. Prior authorization is the mechanism you have heard about when a doctor prescribes a treatment and the insurer says, "Hold on, we need to review that first." On paper, it is medical management. In practice, it is a profit lever. Medicare Advantage insurers processed nearly 53 million prior authorization requests in 2024. They denied about 6.4% upfront. The more revealing number is this: 80% of appealed denials were eventually overturned, meaning the care was medically necessary all along. The insurer just made the patient fight for it. Every day of delay is a day that cost sits outside your claims obligation. Step therapy, making patients try a cheaper drug before approving the one the doctor actually prescribed, works the same way. Every substitution that sticks is a claim that costs less. But the deeper play is vertical integration. United Health doesn't just insure people through United Healthcare, it owns Optum, the largest employer of physicians in the country, plus a pharmacy benefit manager, a data analytics division, and a payment processing arm. CVS bought Aetna in 2018 for $69 billion. Cigna acquired Express Scripts. The three largest PBMs, the companies that manage prescription drug benefits, are now owned by the three largest insurers, and together they control nearly 80% of that market. When United Health insures you, employs your doctor, fills your prescription, and processes the payment, the money you pay in premiums barely leaves the building. The MLR rule says you must spend 85% of premiums on care. It does not say you have to pay an independent hospital to provide it. Now, let's talk about how this industry has destroyed people who got it wrong, because the failure roster is long and expensive. The clearest mass failure in American insurance history is the Affordable Care Act co-op program. Congress created 23 nonprofit consumer-operated and oriented plans in 2014, funded with $2.4 billion in federal loans meant to give consumers a nonprofit alternative to the big carriers. By 2017, 18 of the 23 had collapsed. Combined losses exceeded $1.55 billion. New York's Health Republic failed in 2015 with $265 million in unpaid claims. The Land of Lincoln Plan in Illinois, 49,000 members, folded in 2016. What killed them was straightforward. They priced premiums low to attract members, attracted sicker members because healthy people stayed with established carriers, then watched claims blow past premiums by catastrophic margins. The co-ops did not fail because the people running them were incompetent. They failed because the math of insurance is unforgiving when you are small, sick, and undercapitalized. Oscar Health is the more recent and instructive case. Founded in 2012 by Mario Schlosser and Josh Kushner with a technology-first consumer pitch, Oscar raised over $1.6 billion in venture capital and burned through most of it. It lost $571 million in 2021. It lost $610 million in 2022. It finally turned its first annual profit in 2024. 12 years after founding, $25.4 million in net income on $9.2 billion in revenue. Not bad, right? But medical costs in the individual market ran hotter than expected in 2025, and Oscar posted a $443 million loss for the year. One bad actuarial cycle erased a decade of grinding toward profitability. Oscar did not do anything obviously wrong. The math just moved faster than the model. There are two failure modes that repeat across this industry with mechanical regularity, and they almost always arrive together. The first is the adverse selection death spiral. You enter a market, price plans attractively, and the members you win are disproportionately sick because sick people shop harder for good coverage. Healthy people stay with their employer plan or do not bother switching. Claims run high, so you raise premiums. When you raise premiums, healthy members leave first because they are most price sensitive. Now your pool is even sicker. Claims run higher. You raise premiums again. The cycle accelerates until you are insolvent or you exit. In 2017, both Aetna and Wellmark pulled out of Iowa's ACA marketplace, briefly leaving 94 counties with zero insurance options, a textbook adverse selection outcome played out at state scale. The second failure mode is medical cost trend underestimation. Healthcare inflation runs at 7% to 8% annually right now, and PwC projects 8% for group plans in 2025, up from 6.5% in 2023. When you file premium rates 12 to 18 months in advance, you are betting on where medical costs will land by the time claims actually arrive. Miss by 3%, and on $720 million in premiums, your medical loss ratio jumps from 85% to 88%. You have lost $21.6 million in profit to one actuarial error. Miss by 7%, and you are losing money on underwriting entirely. In 2024, industry net earnings dropped from $25 billion to $9 billion as post-pandemic utilization ran hotter than anyone's models predicted. The insurers who got crushed were the ones who had priced aggressively to gain market share. Okay, step back, because there's a paradox at the center of this business that never fully resolves. You are selling a promise. When something bad happens to your body, we will pay for the care that fixes it. That promise is infinitely elastic on the customer side. They always want more covered, more approved, faster authorizations. But the promise is constrained on your side by actuarial models, state regulations, federal medical loss ratio rules, provider contracts, and investment returns on a float you do not control. You are promising something you cannot fully predict to people who will always ask for more than you planned for, regulated by the same government that is also your largest customer through Medicare and Medicaid. The product is priced before you know what it will cost. The cost is set by human bodies, which are not rational economic actors. No other industry operates under those conditions simultaneously. That is the architecture of the thing, and it produces the one axiom in this business that holds in every market cycle. You cannot outrun the math. You can only grow large enough that the math works in your favor. Let's run the final numbers so you can see what this looks like in practice. You've built a regional health plan, 100,000 members, average premium of $600 a month. That's $720 million in annual premiums. At an 85% medical loss ratio, you pay out $612 million in claims. You keep $108 million for administration, technology, staff, compliance, and profit. Investment income on the float adds another $8 million to $12 million at current rates. Call it $115 million in gross operating income, a 16% operating margin. In health insurance, that is an excellent year. But here's the realistic scenario. Medical cost trend runs at 8% instead of the 6% you modeled when you filed rates 14 months ago. Actual claims come in at $655 million instead of $612 million. Your medical loss ratio hits 91%. Underwriting margin is $65 million instead of $108 million. You've lost $43 million in profit to a 2% actuarial miss. Investment income does not cover the gap. You either eat the loss, raise rates next year, and risk losing your healthiest members, or narrow your network to steer patients toward lower-cost providers, which triggers regulatory scrutiny and starts the slow leak that becomes a death spiral if you are not careful. This is not a theoretical scenario. This is what happened to the entire industry in 2024, when post-pandemic costs ran hotter than models predicted, and profit margins across the sector collapsed from 2.2% to 0.8%. The only insurer that weathers that storm without existential consequences is the one too large to fail on a bad year. Stephen Hemsley ran United Health Group from 2006 to 2017. When he took the CEO chair, revenue was around $70 billion. When he handed it off, it was approaching $200 billion. The model he built, insurance plus pharmacy plus care delivery plus data analytics, all under one roof and all feeding each other revenue that never left the building, is why United Health earns money when competitors are bleeding. In 2024, while industry profit margins collapsed below 1%, United Health held above 5% because Optum's revenue padded the numbers the pure insurance segment could not cover on its own. The lesson from the biggest winner in this industry is the same lesson running through every failure in it. In health insurance, size is not a luxury. Size is the product. The only durable way to own a health insurance company is to own one large enough that the math works in your favor even when everything else does not. Every other strategy is a bet against the actuarial table, and the actuarial table has never lost a long game.